Hey, sunshine.
We're live.
We're live. Can you believe it?
Yeah.
We're back. We're live. We're 15 minutes late after 45 minutes of setup. Uh, thank God for Tyler behind. Well, folks, we're back with episode 2, season 3, Pirates of Finance. We are your hosts, Jason Buck over there on my, I don't know, screen right, whatever. If this is audio. And I'm Corey Hoffstein. And look, before we get going here, let's add a few disclaimers, disclosures. Tell it like it is. We're just a bunch of guys chopping it up on a Friday afternoon. We might talk finance, we might talk business, we might talk entrepreneurship. Whatever we're talking about, it is not advice. It is not a recommendation. You should probably just ignore us. The cost of admission is free, and that's the value of the advice as well. And by the way, it's not advice. Jason, how did I do?
Based on the time it took us to get up and running today, yeah, you probably shouldn't take our advice on anything. And I also you were saying maybe the audio would be better, but now I also have to put out a mea culpa on the audio as well to like Not Midlife and other people on Twitter that have been asking for the audio. It's probably going to be a few weeks until our audio gets approved for platforms as well. So we're going to get there eventually. You and I are always figuring everything out as we go. We just try to at least get the content out and shipped.
It's amazing we know how to put our own pants on, to be quite honest, with the shipwreck that this whole situation is. So, all right, onward and upward. Let's keep going. In the chess game that is hosting this show, Jason, I know that if I let you go first, you will just pepper me with questions for an hour. So I'm going to start. And I don't want any sneaky maneuvers where you try to turn this back on me. But I had a really interesting conversation this morning. Part of my day job is doing due diligence on new exchange traded funds that come to market. And there are a whole host of new funds that are coming to market that are using more complex derivatives. One of the new products, and I don't want to say the name of this product, but one new product that just came to market has embedded within it a inflation swap, has embedded within it a 2-year interest rate swaption. And so you're getting these more complex derivatives that I feel pretty comfortable at least doing due diligence on and asking the questions because of my background. But I think they're kind of difficult things for most people to understand, and I sort of question whether they should be in 40 Act products. But where I'm going with this, Jason, is that what's unique about managing an open-end fund, like a mutual fund or an ETF, is that you don't have control of when the money comes into the fund. So you can place a trade today and say, I really like this trade as what I would call a destination trade, that I'm putting it on today, and I think based on a range of outcomes, I'm going to ignore what happens along the path, and I'm doing this for the destination. And the problem is, because money comes in and out of the fund along the way, the returns for investors are inherently based upon the path. That you could, for example, buy an option today that you think is very undervalued, and then, it could run up in price, right? It could gain delta. It could lose convexity. It could become more linear, and you could say, I still want to continue to hold this. My thesis is true, but the risk profile of that automatically, and if someone enters the fund at that point, there may be a lot more downside to that position than there was when you initially put the position on. And so I just wanted your thoughts on this. A friend of mine, Guillermo, goes by New River Invest on Twitter, always says you can only have it one of two ways. You can either have a trade that you're managing the path, or you have a trade that you're managing the destination. You can't have both. And I'm starting to come around to the view that if you manage an ETF or a mutual fund where there's constant subscriptions and redemptions, you're almost forced to manage to the path.
Well, I wonder, even like you're saying, with the constant inflows and outflows, it almost goes back to your rebalancing timing luck. And so do you think it's better to have like that path dependency, like where you have a little bit of control where you could do weekly rebalancing and tranche those out, or then you have to sometimes do daily depending on how big the inflows or outflows are? And I think what you're hinting at is fantastic, is really interesting to me, because something I think about often is path dependency, like if you're just buying, bonds, you have that football like effect. Everybody's trading the interim, but you know where that it's going to converge to the price eventually. And then the other question you have is with options. So like we even will work with at very small increments that will trade 7 to 10 year leap options. So you have these interesting things that happen. So a perfect example of what you're saying is like they had some option trades on the Russian ruble, right? Absolutely collapses when Ukraine happens, right? But then, okay, so how do you rewrite that premium or restrike that premium if somebody's coming new into the fund or somebody's coming out of the fund? And then if you just hold it because it's like a 7 to 10 year leap option, then all of a sudden that trade came roaring back. And so like that premium can be very fickle on these like 7 to 10 year leap options. And so like, yeah, how do you price that in? And what I think about often is when we are building our fund is you and I kind of believe in either tranching your rebalancing to avoid that timing luck, or you potentially using rebalancing bands. It's usually better than just an arbitrary monthly rebalancing, right? And then especially if you're rebalancing in as you would like to point out, rebalancing requires some form of mean reversion in the assets you're using. So sometimes, longer term, it's arguable what time horizons work for rebalancing, asset classes or return drivers. So you might want rebalancing bands or maybe quarterly rebalancing, but then functionally, if we allow monthly liquidity and you can rebalance on the monthly basis because we have inflows and outflows, you have a forced rebalancing on a monthly schedule, and that might be suboptimal. And so, this is the trade-offs, like you're saying, is like in an ideal world, we could maybe run portfolios in a certain way, but the trade-offs of the real world do not ever really overlap perfectly with the optimal world.
Well, I like that concept because to sort of play devil's advocate to myself a little bit, the other way I think about this is every day you wake up, you should be saying, what is the optimal portfolio for me to hold today? Right? And so in a weird way, like this whole idea of managing to the path or managing to the destination, like why wouldn't I just wake up today and say, you want to know what, this option, this highly convex position is all of a sudden much more in the money, lost a lot of convexity, there's a lot more downside risk to the position. Is that even the position I want to hold today now that I'm halfway through my trade, right? Information has changed, right? And if it's not the position I want to hold, then why wouldn't I as a portfolio manager ultimately change that position? So that's where I sort of go back and forth and I say, I'm not sure it matters. Like there's all the realistic limitations of trading costs and liquidity that we need to be aware of. But this path versus destination idea, sometimes I just say, no, every day I should be waking up and saying, what is the optimal portfolio given the information I have today manage towards, and then try to get as close as I possibly can to it.
Yeah, it's like the idea of zero budget balancing right at the beginning of the year, right? Like, what do I want and what I don't want? But like you just said, the rub is the transaction costs. Like ideally, yes, you would wake up every day and figure out what is the optimal portfolio, but then we're hit with those transaction costs, slippage, commissions, etc. I do want to throw it back at you in a way though, because I think a lot of times when we talk about rebalancing, you're always saying you're essentially then short the winner that you're taking money away from. But I like, so you have like a latency. I always have a hard time wrapping my head around that when you say that. So it's almost like a latency effect. So you're saying even after you made the rebalancing trade, you should still think that you're short the amount of money that you rebalanced out of your winner to give to your loser. Is that what you're trying to say? Like, I've never really wrapped my head around when you're saying that.
This is sort of my, like, you've heard the phrase turtles all the way down.
Yeah.
Well, for me, finance is long short portfolios all the way down.
Right.
So what do I mean by that? So we have a 60-40 portfolio as a very standard 60% stocks, 40% bonds. And let's say stocks have outperformed bonds. And so now if we do a decomposition, our portfolio is 65% stocks, 35% bonds. And we want to go back to the 60-40. Well, there's one of the easy ways to do that is you sell some of your stocks, buy some of your bonds, and great, you've gotten back. But selling some of your stocks and buying some of your bonds is functionally equivalent on paper as basically saying, I'm going to go long bonds and short stocks. So I'm going to hold my 65-35 portfolio, and I'm going to go long 5% notional exposure in bonds, short 5% notional exposure in stocks. And I'm just going to layer it on top. And A plus B, it gets me back to a 60-40. And so I am now perpetually, and so every rebalance I do, I can just think of adding a new long short portfolio. Now, That said, if there is no mean reversion, no trend, then over time, all those long short portfolios should really just negate each other, right? The next
Right.
rebalance you do might be the exact opposite, and they'd all just sort of net out. And over time, it's like you just held a 60-40, on average. But for any individual trade, you are effectively expressing that rebalance as a long short portfolio.
Yeah, that one just I thought you meant that, and like, so you're keeping that in your head, but like that to me just rings of semantics, and it almost like it
So,
no, hold on,
yeah, it's not just
just
semantics, though.
let me finish the thought though for a second. It's like, what's the Whitman quote? Do I contradict myself very well? Then I contradict myself. I'm large. I contain multitudes. But it's contradictory to what you were just saying before about almost zero budgeting, coming in fresh, looking at the portfolio every day. Instead, in your mind, you've got this like series of long short portfolios that you're bringing to the table. If you keep that that hindsight bias.
Well, that's more of an accounting methodology, right? So what I would say is I wake up in the morning and my optimal portfolio is a 60-40 and I'm at a 65-35. And so I want to rebalance back, right? And then the question is, how do I express that rebalancing? Well, that rebalancing, I can think of just selling my stocks and buying bonds. That's how everyone in the world would think of it, right? But
Right.
mathematically equivalent is saying I didn't touch my underlying portfolio and I went long bonds and short stocks in the right proportion to get me mathematically to the same place. And so to me, it's actually not in disagreement, and it's not just semantics. To me, it's a really interesting way of thinking about portfolio accounting, and actually really, really useful when you think about how things are contributing to your portfolio at any given time or even over time, right? You could, and I've done this in the past, is say, I'm going to take a 60-40 portfolio and rebalance it every year. And then at the end of every year, I'm going to create the long short portfolio that gets me back to a 60-40. And I'm going to track how that individual that long short portfolio did. And you can actually see how different rebalances contributed to your portfolio over time by tracking that very specific long short tranche.
And wouldn't that just be a proxy for, in hindsight, if we had trend or mean reversion, right?
Yeah. Since you did that, and what you find is like, if you do a 60-40 portfolio, because stocks have generally outperformed bonds over the long run, most of those long short portfolios have you selling stocks and buying bonds and then underperform. So you would actually look at that and say a lot of the times if you're just rebalancing annually, rebalancing has actually ended up being a drag on your returns. You would have been better off, in the US at least, just letting your portfolio drift to a majority holding in equities.
Right. And then my pushback would be like, not just semantics, but like that's hindsight bias, right? Like that's what I'm saying. You're like, you look at it and you go, great,
100%.
this told me for last decade, I should have just let the stocks drift. It's like, congratulations, but that doesn't help you today moving into T+1
Right.
tomorrow, right?
Yeah, this is just like, to me, this is just a really interesting accounting
Yeah, I
thing
getcha.
that I like. I have a lot of, I think you know this about me by now. I have a lot of weird little portfolio things that, like, the way I think about the world.
Yeah.
And one of them just came up this afternoon on a conversation in Twitter. Like, the other thing I use, a tool in my toolkit that I use a lot, is like thinking about the world at extremes. So there's a conversation going on about like someone was launching an ETF. Someone else was saying this is a horrible idea. I wish I could short that manager.
Yeah.
And someone else commented, well, why isn't there sort of a market where you can be like, I think that manager's an idiot. I want to go short that manager. And my point was, well, let's say you take this to extremes, because we know that if you bought every active manager in the world, all their trades would net out and you just get back to the passive portfolio. So in theory, wouldn't it be like a great trade to go basically short every active manager in the world, long a passive portfolio, and you would capture the net difference, which would be
Right,
costs?
right.
Right? And you go, well, that doesn't make sense, because first of all, who's paying me those fees and transaction costs? Second of all, that sounds like an arbitrage to me. And markets are generally pretty efficient. So what should probably happen is that the cost of borrowing that short would actually go up to meet the expected fees and transaction costs, and you would end up with nothing. But you can, like, the logic for me to get there was, well, let's take this to the absolute extreme, which is I'm going to short all these active managers, which to me makes the math very, very clear, right? There's no question about is there skill, is there whatever. It's just like, no, we know how this math plays out. So anyway, so that's another one of my very weird Corey has developed over time. Like that's how I try to build intuition around this stuff.
Well, at first I thought you were just trying to be weird for weird's sake, so that tangential take,
Well,
so it draws
that's
attention.
true.
But no, I get it. Like actually, I like thinking about that now. Now that we're actually talking it through, like thinking about it long short, and it gives you. It may be semantics in my opinion, but like it does give you maybe an oblique or tangential way of looking at it, which is always helpful to like kind of think through the processes of what you're doing. I'm wondering how you think it relates, going back to your original question about, you know, path versus destination. How does it make you think about like closed end funds like Pershing Square when they trade like a discount to NAV and like closing that gap, even though sometimes that gap doesn't close, it stays open or it widens. So like, because like that would easily be a long short, you would think, but like, how do you think through those like kind of portfolios?
Yeah, I mean, truthfully, I don't know the closed-end fund market particularly well. You know, I think basically what happens there is you get some embedded leverage, you get some embedded illiquidity, and there's all sorts of reasons why those things may trade at a premium or discount at any given time. But I like my null hypothesis when I think about the market is that it's efficient. That easy arbs probably don't exist. And so if you see something trading at a significant discount, there's probably a good reason it's trading at a significant discount. Like either it's very hard to arb away or there's a very important piece of information that you're missing, right? And so I think often when people look at that stuff and they say, oh, it's trading at a 25% discount, you know, to NAV, that's an obvious buy. It's because there's a lot of people in the market looking to put money to work at obvious easy buys, and if it was that obvious and easy, it would probably get scooped up already.
No, I want to go back to the original part of your question, and I'm not
How did
shitting
you
on
flip
any of
this
these.
around on me? How
I
do
know,
you
I'm so
do
good at
this?
it.
You're so
It's
good.
well, I just went because we didn't finish the thought. It's like because I had the initial question about at the beginning is like I don't want to shit on anybody's portfolio construction, any of these ETFs, and I think that everybody pushing the frontier is really helping all of us. I just can't understand these ISDA based contracts with you know, insurance swaps and swaptions and everything is like, and the third party risk is like, how are the APs making a market in this? And like, does it work when times are good? But then as soon as times explode, like, how are you going to get a proper mark to market on these ISDA contracts within an ETF? It's like overlaying liquid structures on illiquid structures, even though they're liquid on the, but you need the counterparty to pay you out on that liquidity.
Right. Yeah. I mean, so these are all really good questions and questions you have to ask in the due diligence. So one of the questions I ask product like this is I ask about the create redeem process, right? So again, for people who maybe are listening that don't know about the create redeem process, if you give your money to a mutual fund manager, they get the dollar into a bank account and then they go spend it. When you go to buy an ETF, typically what's happening is you're going to an exchange, you're buying the ETF off the exchange, and the person selling it to you is usually an authorized participant, also known as a market maker. And what they're going to do is they're going to basket of underlying exposures and give it to the fund manager, and the fund manager is going to give them shares of the fund back in return, which they can then sell on the exchange. So that's the create process. The redemption process is the reverse of that, where they give the manager shares, manager gives them underlying exposure. Just to set the table as to like what we're talking about here. So then the question becomes like the manager gets to set the basket, and depending upon how complicated the basket is, that's one of the things that governs how liquid the ETF is, as well as how tight the bid-ask spread is. And so to your point with these, like, how is a market maker going to be quoting if the basket is going to have esoteric swaptions or inflation swaps in them? And the answer in this case is they don't. The basket, the fund itself is basically 90% short-term tips, 10% cash, and then that cash is being used to buy premium in the rate swaptions and when you enter into a swap, there's zero cost at the beginning, right? So it's just being used as collateral for the mark to market in the swap. And so the basket that they ask for is basically just tips and cash. And so that they
Right.
sort of circumvent that issue. But your other point, I think, is 100% critically important. You have a daily mark to market product And you have to ask, how big is this OTC derivatives market? Like, these are not exchange traded derivatives. And that, to me, is a hugely critically important. Who's on the other side? How are you managing your counterparty risk? How much liquidity is in this stuff? How big can this ETF get? Because if you're telling me there's $200 million of trades in swaptions every day, and your fund is, or swaps, and your fund is, $1 billion, what happens in a crisis, right? So yeah, these are
And not
these
even
are
just a
real
crisis,
important
like you're saying, like,
questions.
yeah, I was thinking twofold. Is like what happens in a crisis, or like especially if you have a drain on the on liquidity at the fund level. But what even happens on a daily basis, right? If all of a sudden you run a billion, you get 100 million comes in on a daily basis, you got to call up those OTC desks to make a market for you. What if they're not willing to take it? Like, what do you do? Because there's, and I'll get to that. Reminds me of the ARC video we did a while back. But the second part I'm wondering is like, is kind of the worst case scenario, right? If the APs are pricing just a basket off of like tips and cash, is like if markets go wild and you can't really get a proper mark from the OTC counterparty, are they just going to blow out the bid-ask spreads by like 5-10%?
Yeah, they might.
I mean,
I
that
mean, I
would be
guess
the
it
thing,
doesn't.
right? Like,
I guess it really doesn't matter. I have to think about this. This is me shooting from the hip, but I'm not sure it matters
yeah.
because whatever they redeem is tips and cash. And so it's just a question of like, do they feel comfortable making the mark around NAV? Like, it's just NAV wrong.
Yeah, because and the tips and cash could remain the same, but then your overlaying derivatives have just exploded.
Yeah. So it's not, to me,
So,
it's not really a question around like the bid ask around NAV might blow up because there's uncertainty around the NAV
right,
potentially,
that's what I'm
right?
saying.
But it's
Yeah.
not so much like the liquidity of the basket that they're having to buy or sell that's going to determine the bid ask in that case. But yeah, I mean, well, tips themselves get pretty illiquid. So yeah, in a crisis, like it's a very interesting question as to whether these are appropriate or not, right? These two, like I sort of encourage it, but I encourage it because I feel comfortable doing the analysis. But I also, this is like a huge theme for me lately, this idea of structure. You and I have talked about this a ton. Like,
Yeah.
what is the appropriate structure for all these different strategies? And I'm not sure ETFs are the appropriate structure for all these strategies necessarily.
Well, and I'll get to what I think could potentially be, and I'm curious your take on it. But I just want to point out one of my favorite things, just to needle at people a little bit, is when you just said about tips not being the most liquid. I like to refer to them as they're in inelastic hodl, like a lot of cryptocurrencies are. And that just like annoys both sides, right? Like equating
Yes.
tips to cryptocurrencies is just going to annoy both sides. But it's the same thing because you primarily have hodl participants with like BlackRock, Blackstone, Bridgewater, and the Fed. And so like it's a really inelastic market of primarily hodlers that people don't think about what is the actual implications of the market participants and what are their end goals with what they're doing. But so let's go back to like the structures that you create is that's what I was wondering. Like when we were talking about ARC, when we did the video a long time ago, we were comparing ARC to Janus, but the primary difference was ETF versus mutual fund. Is that Janus had the ability to shut it down because they were getting too many inflows. Where in the ETF structure, technically, they have to take all those inflows, even if you don't want to take them and you don't have a place to put them. So that's a kind of a terrible structure in a way to put yourself in, even though it's convenient for realize what it's doing as you try to cascade those allocations as they start running up, and you can't really put them in without ballooning the prices of those individual sub equities that you're trying to buy. And so I wonder if you are going to do ISDA contracts, is the proper structure an interval mutual fund where you can kind of control those inflows outflows on a more like a quarterly basis?
Yeah, it might be. And then to even tie back further to the original question of path versus destination, if you know cash is only coming in on a quarterly basis, does that allow you to change how you're going to execute your trades? Right? Because you don't have to deal with money coming in, you know, intra-quarter. And right, I was asking about this problem is especially with a small fund. Let's say it gets seeded with $20 million and an institution loves it. And I buy in at 20 and then 3 months later an institution comes in with 100 million. Well, what are they going to do with that 100 million? Are they replicating my original positions? Well, they can't necessarily. So they're going to have to put new positions on. And how does that change overnight the risk profile I had in that fund? So yeah, I mean, I think depending upon the structure, like the quarterly gating or semi-annual gating or whatever you do with a fund like that, I think can tie directly to how the fund is managed. Again, going back to the open-end nature of a mutual fund or an ETF, where you can't control the inflows in and out other than just flat closing the mutual fund. Yeah, I think there's some complications that often don't get discussed and are hyper relevant as we're getting more convex derivatives shoved into these structures.
So we were talking about like, you like to have this thing with long short portfolios all the way down just to be a little bit, tangential to everybody else. The one I always think about is like with these options, especially the options that you and I traffic in, is like a lot of times I almost think they're mark to model more than they are mark to market. And like you're saying, especially if you have inflows and outflows, it's like the expansion and contraction of those prices before you get to the terminus is almost like bonds in a way. It's like it's kind of irrelevant. I mean, it's obviously the fear, and it's an indication of fear, but it's always like, as it expands and contracts, and you have like people even on an intramonth basis where you've had like tail risk managers on an intramonth be like, this is our P&L is expanded by like 50, 80, or like even exponential 4 or 5, 8x returns, but if you didn't monetize it, it was on paper. And like
Right.
you're saying, like, are you playing the path of the terminus? Like it's this is one I constantly ruminate on, and I honestly don't have any good ideas after like literally thinking about it for a decade. It still messes with my head all the time. Are we talking about path or terminus? And is that does that value matter on an intermonth or interday basis if I'm not monetizing anyway?
Yeah, I think it's a really good question, because let's say you have a model that you can forecast really accurately 12 months out. And so you buy an option, right, with a forecast 12 months out. And a month later, right, the option is worth 5 times as much,
Right.
right? And did you meet your forecast early and therefore you need to sell? Like, and I think these are the questions you have to ask yourself, like how much more upside is there to that position versus how much downside is there? I remember I did an interview a couple seasons ago on my podcast where I talked to a manager who specializes in commodity options. And he was telling me, like, the hardest part about managing options is that when you're right, the risk goes up, especially if you're long options, because this was a long option
Right.
trader. So you're buying highly convex instruments. You're buying a very fixed premium that you can lose, and then all of a sudden you're right, and the value of that option goes up 5 or 10 times, and now all of a sudden you've got 5 or 10 times the amount of money you can lose from that mark, and it's near. And so to your point, I have become much more of the view that these things cannot be managed systematically. That when I see convex derivatives in a fund or an ETF, it better not be indexed. It better be actively managed. And the conversations about how are you monetizing, how are you rolling, how are you avoiding rolling timing luck, right? If you just roll your positions every 6 months and you happen to just get unlucky and hit when markets are implied vols are high, you're just constantly getting unlucky trades. Like, how are you managing that's really important. But to your point, like, I'm not sure you can ignore the path. By the way, I do want to say, I feel like our conversation has gotten so esoteric. There will be 2 people in the world that will tune into this.
I don't think so, because I'll bring it back in some other ways. Because no, I think that the people. By the way, only 2 people ever listen to us anyway. So hopefully they're self-selected on these 2 lunatics they're listening to. But part of it is like, and to give your example, is not only in if you have a 12-month P&L forecast, and in the first month your options explode to the upside in a good way. Like you said, now your drawdown is like you're staring at a crazy drawdown. But in that scenario too, what you're also not factoring in that you kind of brought up tangentially is like you have to think about the second order effect. Is if you did monetize that, now you're naked for another next 11 months. Or if you want to put that protection back on, now you're paying up for that same implied volatility.
Right.
It's like selling your house and then you have to buy a house in the same neighborhood where all the prices rose, like rising tide lifts all boats. It's
Well,
like, did you really manifest that wealth, right?
I think you're spot on, because, like, right, you can't. And let's go to the world of bonds really quickly, because I feel like maybe this is easier with bonds.
I was going to bring it back to CTAs as well. So go for bonds, and I will
So
talk about CTAs.
I own a U.S. Treasury bond that's got a 2% yield, and over the next year, yields go up to 3%, and now my bond is worth less, right? And the reason it's worth less is because you need it such that the coupon paid versus the price that you pay for it should equal the 3% on the run that I could buy if I didn't own the bond. So I sit there and I'm mad, and I I go, I'm irrationally saying like I'm not earning as much coupon as I could, so I sell my bond and I buy the on. Literally nothing has changed about my position, right? I bought less of a bond paying more coupon. And so just like all I've done is changed, I'm going to use the word numeraire. You just sort of change numeraire and you're left with the same sort of outcome and wealth. And so the only way monetization works is if you go to a very different position. And so again, it goes back to that point of if you're making that decision, the decision should be based upon like what is the optimal portfolio I want to hold today versus what do I hold and how has that changed? And the question then becomes, do you have the ability to manage the path? Like if you're only forecasting every 12 months, like what happens halfway through if you don't have a new forecast? How do you manage the path? Or do you just not? You know?
Well, and that's assuming also another ceteris paribus of that your fund are staying the same, right? That you don't have to deal with these daily fund inflows and outflows that we both have to deal with, yours on a daily basis, mine on a monthly basis. But the other part of it is like what you also expanded on is this, I've been following CTA trend followers for God, since I was a teenager. So, decades. And it seems like it's a perpetual argument with CTAs still that nobody solved is like when they're up big, is that open profit? Should they be worrying about the drawdown from open profit or is it only on closed profit? And so this is a perpetual argument. So part of it, like I think it just kind of clicked for me is like the people that are managing the path with vol targeting on open positions, they're managing for path, and classical trend following is managing for terminus, and they're not really worried about open profit. But that's
Right.
always question is like, is your open profit your real P&L? Like if you were saying if you woke up that day and you wanted, is this the most optimal portfolio? You might then vol target the weighting on that. Is that fair? Like kind of the way I'm thinking about it, or like?
I think so. Like the way I would almost think about it is, let's say you wake up every morning and your portfolio's cash. Like, would you buy back the exact same positions you had overnight? If not, right, then you should be changing your portfolio. Now you have to taking into account transaction costs and impact and all that sort of stuff. And to go back to something you said, you mentioned that, I have to deal with daily inflows and outflows. You have to deal with monthly. I do want to point out that's not all bad, because what can happen is if I'm getting daily inflows and outflows, I can use those inflows and outflows to make trades that push me towards where I want to be optimal. Right? So if I say I've got position A and I want to get to position B and I get a whole bunch of money in, I can buy the positions that get me towards position B. Right. And so there are ways in which cash coming in and out can be repurposed to push you towards where transaction costs you were going to have to make anyway.
Right. And you don't have to crystallize the losses on the other side. Yeah,
exactly. But so it's hard for me, right? Because I go, like, clearly I think I want to have a view every single day, but that's not how all models work necessarily. Like, not every model gives you a view every day. And so you have this sort of like path gap that sometimes you're in the middle and you're going, I'm not going to have a view based on the way my models work for another 2 weeks, but this position right here, maybe it's just getting out of risk range, or maybe it's like really popped beyond my forecast and I need to figure out what to do with the position and then what to do with the capital. And it's not always obvious.
Yeah, I think this is this actually gives me a great segue or transition because it's right in that vein is Gerd Gergerenzer was on Econ Talk, and to simplify what he does for a living, I think he primarily writes about like complex systems and in our abilities to understand the world. But one of the things he was talking about was MPT, modern portfolio theory. So this is kind of what we're getting is like, are we going for optimal or are we going for robust, especially given the constraints of all the different factors, both known and unknown, that we have to deal with on just running the business of investment management. And he was talking about how modern portfolio theory needs an absolute ton of data. The more data, the better, right, for modern portfolio theory to work. And the problem is we can never get enough data. But what's interesting, and you and I have had many discussions about this and maybe arguments, is that 1 over n doesn't require any data, right? It's very robust. And so is there a difference between robust versus optimal trade-offs? And I would love bringing up the anecdote, and maybe I have on the show before, is that Markowitz did all the work on modern portfolio theory and then asked if he used it in his own investing. He said, no, I just go 50-50 stocks bonds because I can't get enough data. And so that's what people don't think about. So the other part of that is with using enough, if you could get enough big data and using AI, he started like talking about that as well. And he said, using big data, you require stable versus unstable worlds, and if the future is unlike the past, then big data is not going to help you at all. And that's the difference between a stable and an unstable world when we're talking about logic fallacies of stable worlds versus dealing in an unstable world and dealing with human beings that we're dealing with. And I thought this was an interesting, just fun anecdote. He said AI can win at chess, but AI doesn't know that it's playing a game called chess. It's like the common sense, it doesn't factor into the AI. I just thought that was interesting, and I can't wait till after we're done with this to get Tyler's opinion on the big data problem.
It's funny because, man, how do I want to phrase this? Part of me is saying, if you believe markets are efficient, right? Not that we do necessarily, but if you believe markets are efficient, big data actually presents an interesting opportunity, because what efficient market theory would tell you, what modern portfolio theory would tell you, is that you want to buy all the assets in the world in proportion to their value. Now, obviously, you can't buy all the assets in the world. I'm sorry, you are never going to be able to own part of my company. Like that's not generally available.
I'm trying.
Not you, the general you, right? But so it's a theoretical exercise. But even just like asking, well, what is the value of global equity markets? Okay, that's easier on the public side, not as easy on the private. What is the value of global bond markets? Again, easy on publicly traded. How do you start to think about real estate value? How do you start to think about all these other assets that should actually be included? Big data, actually, when you solve that problem, big data might be an interesting solution, right? But that is disjoint from the other point, which is big data going to help me forecast expected returns better than other people and build, an optimized portfolio using modern portfolio theory that has better expected returns, a better covariance matrix, all that? I don't know. I've never seen it work.
Well, I always I think, correct me if I'm wrong, this is what you usually say something to the effect of markets are generally efficient, but like around the periphery, they're inefficient. Is that and it would sound like a cop out, I always think it's like a cop out when you say it, but actually I almost agree, because the way I always say is everybody looks at the world as it's either A or B. And I'm always see it, all the above. There's a lot of nuance in there.
That's not really my phrase, but last Peterson from AQR, I think he's from AQR, has a book called Efficiently Inefficient. That's basically saying like markets are mostly for the low hanging fruit is all pretty efficient and it's hard to beat. But there are edges where it's not efficient, where you can be, a liquidity provider to certain types of behavior or take advantage of other people's utility, risk aversion, leverage aversion, that there might be opportunities to harvest excess risk adjusted returns.
Or I should say, I think what you say is your base assumption should be that markets are efficient. So if you think you found an inefficiency, you better be really damn sure and double check that 10 times, because it's likely you're wrong, not that this inefficiency is laying in plain sight.
Okay, now this is something I want your thoughts on, because this is something I've sort of changed my mind on over the last couple of years. Is that, let's say, so your null hypothesis is that markets are efficient, and you said you better be damn certain you found something, right, to overcome that null hypothesis. My view now is I'm not sure you need to be damn certain, because let's say you're looking for an edge and you find an edge. Great, you're going to harvest some alpha. But let's say you're looking for an edge and you don't find an edge. Downside there. Well, we would expect random trading noise, right? We wouldn't expect negative alpha necessarily. And in fact, by design, it might not be negative alpha, depending on how you design your tests, minus transaction costs. So if your upside is you find alpha minus transaction costs, and your downside is you get random noise minus transaction costs, shouldn't we be a little looser with the alphas we're willing to include in our portfolio? Because isn't that more of an asymmetric trade-off?
I just, solipsistically, I hope I've been part of this wedge that has created this fracture in your thinking about it. Because this is one of the always things I harp on. And then for everybody behind the scenes, nothing makes me happier than Inception, where Corey will repeat back to me things I've told him like it's his idea.
I want you to know, it wasn't you. I'm sorry. It was a Marcos Lopez de Prado paper that he wrote a couple of years ago.
No, I know, but we were actually talking about this on the previous show. I think is the idea of if you can find an inefficiency and you can prove it, then it doesn't likely exist, right? Like if you find inefficiencies, you can't prove it, you got to trade it and then hope for the best is like what you're saying. Like I'm overly simplifying, but you get my point is like, if an inefficiency exists and you could do a 2 decade back test, like it's already been arbed away. So you have to actually look for trades that you can't necessarily prove. Like you were saying, it has maybe some positive convexity and otherwise I'm just getting noise minus transaction costs.
Yeah, I have a podcast that will hopefully be coming out in the next couple of weeks where I'm interviewing this young man. I got to keep this very anonymous. Young man who has been trading crypto using nothing but machine learning over the last couple of years and has turned, call it $50,000 into hundreds of millions. And the approach was higher frequency trading, but the prediction models were all over 5 to 15 minute periods. Like this is not super high frequency market making. This person does not come from a finance background, comes from a data science and machine learning background. And basically it was all about, as far as I could glean, right? It's always like trying to figure out what they can share and not share. All about basically trying to use that higher frequency data to train in as robust as possible a way a set of models that he would, when they started to work, bring them in. There might be 30 to 50 models running at any given time, and then he would rapidly sunset. And like the intuition as to like why a particular hyperparameter set working now versus other times didn't matter. It was just, we know it's working, it's statistically robust enough, and if I do a whole bunch of them that seem to be working, the ones that aren't, I'm just going to end up sunsetting and retraining and bringing them back out. And it is so much the antithesis of what we're taught in traditional empirical finance, which is all about, finding that T-stat and getting your P-value below 5%. And yet the people I talk to who sort of do that have done it in like exchange traded futures markets as well as crypto have all done incredibly well for themselves. And I think part of it might be just like the higher frequency nature, but part of it's just being willing to step out of what's acceptable in empirical finance and say, I don't care about your T-stats. I don't care about your data mining. This stuff works in practice.
Well, and allegedly that's what some people think that Rentec does over time.
Right.
So, but like, I just want to be clear. I thought you said both. So I want to be clear that was he sunsetting the ones that have maybe hit a price stop so he doesn't think they're working, or he's sunsetting based on a time stop of just like, and just an average time duration of
More like
sunsetting any strategy.
Stop, like strategies that have degraded in alpha. He sunsets and replaces with retrained models that are now, sort of constantly running on paper, and then he'll bring them in to run live money.
Oh, that's what I thought it was going to be a lot more interesting too. Like you said, it was just like a time stop of like sunsetting, like using something for a few weeks and then just sunsetting it randomly, just because you felt like there's only a time horizon it would artificially work on.
One of my questions to this person was, okay, like how much, like you're trading pretty high frequency. How often do you really feel like you need to come up with true innovations, right? How, and what was interesting was the sunsetting of the models was every couple of weeks. But he said like true innovations, unique features they identified, new markets, new ways of like training in a robust manner was maybe every 6 months. Right. So the edge was not, as far as I could tell, in necessarily like a process of innovation. Not to say innovation wasn't important, right? But it wasn't like, oh, we're coming up with something new and unique every single week. Like it was just we've got over any given 6 month time period. Like they were sort of using the same model process, but it was all about training and retraining and sunsetting and bringing new models in that were working, and has been insanely profitable for them.
Yeah. Insanely profitable is a good phrase. And by the way, I'm glad this is live, so we can't go back and edit this out. I can't believe you're even like talking about this and giving much to it. But did you ask him that if you're sunsetting certain models, is there a way 6 months after that, do they sunrise? Do they come back? Or is it always new models every time?
So what can happen, and again, this is like my generic understanding, because it's like sometimes I push too hard in the questions. They won't talk about that. But my basic like filling in between the gaps is like when the models sunset, what basically it happens is it's like there's all this big hyperparameter set. And you're retraining these hyperparameters that give the models different attributes as to how they trade and how they express trades and what they're looking for. And so like when something gets sunset, it just gets washed out, and then the new set of models, like something similar might pop up, but it's just constantly like retraining in the background, trying to find like a different range of hyperparameters that seem to be working.
So
What
the
was
strategy could be the same or self-similar. It's the parameter set that's changing.
Yeah, and what was interesting was, you know, one of the questions I had was like, well, how do you potentially not run into the risk of like all the sub strategies converging on the same sort of like meta strategy, right? And his answer was basically like a small change in these hyperparameters like can sometimes lead to like very big changes in the expression of their trades, which I thought was interesting. So it seemed to be like not as big a risk as I would have considered it to be, because the way they're using like the machine learning process of training this stuff, they tend to come up with like even just small changes in the hyperparameters lead to very different expressions.
You know, it makes me think. You said like, you know, we're getting so deep in the weeds here that we're down to like 2 people out of the 9 people that listen to us. We're down to 2. But let's be honest. Like I think about this from the meta level. Essentially, all we're talking about is decision making under opacity and what should my position size be. And so even when you and I are talking to each other privately about our businesses or whatever, right? It's how do I make these decisions under opacity and what should my position size be? So like even going into the weeds about it, it cross replicates across a lot of things we think about. And one of the ones that I was listening to this week, actually this morning, it was great, is Russ Roberts from Econ Talk fame was on Tim Ferriss's podcast. And it was really weird to hear Russ Roberts on somebody else's podcast. I expected it to be Econ Talk, and it was just like throwing my mind off for a second. But his latest book is called Wild Problems. And the idea of wild problems is like you don't have data and you can't really run any sort of cost benefit analysis on these problems. Like one of them would be, and you and I have talked about this a lot privately, is like moving, getting married, having kids. Like, especially he kept going back to the having kids and like Darwin doing a pro and con list and how ridiculous it was because as a bachelor, he had no idea what it was going to be like to be married or have kids. But once again, like it's almost like we were kind of going through at the beginning of this, relating it to trading and ISDA contracts and everything. Is like, what do you do for a lot of the decisions we make in life? They're not amenable to data.
Yeah, or that you don't get repeat trials at.
Right.
Right.
It's a one-off event.
Like there's no or
hopefully.
Right. Marriage you can maybe do as many times as you want. Right. But ideally, like you're trying to make that choice. There's a great book called, oh man, I'm going to blank on the name, but it's basically like computer science algorithms applied to real life, which sounds really boring, but I think I've recommended it to you in the past. You know, these issues that have actually been classical computer science problems reframed in the context of like modern decision making. So the bus stop problem. You go to a bus stop and doesn't tell you when the bus is coming. What's your expectation for how long it will be until the bus shows up, right? That's an interesting. You know, how long do you wait? The other one is like called the dating problem, which is okay, like how many people should you date and sort of get to like rank before you run the risk of you've seen the best person, like or the best person is still yet to come. And there's actually like in a weird way you can map out like the correct number. It's a little.
Yeah, what was it alleged? Like, there's some data set. Like, if after you dated like 13 or 16 people, if the next person that comes along is like 60% better than the majority, then just marry that person or something.
Yeah, something like that. It's been a while since I've looked at it. Cold and calculated, right? Like you just basically like you're not accepting person number 1. You like person 1 through 12. You're like literally like I'm just dating you to get a sample reference, which is again not great. And the question is like how much time do you really need to get that sample reference with a person? Like is it one date? Is there like that? These are tough questions, but yeah, life is decision making under opacity. I think you nailed it, and that's what a huge amount of working in finance is like when you're managing portfolios. And I think a lot of it is trying to control for the downside risk of the things you don't understand while still maintaining exposure to the upside potential. And that's business, that's life, that's everything.
So part of that, I'm looking at like maybe your list of bullet points and notes is I think related to this, and maybe not. Maybe I'm misunderstanding your just short and bullet point. is you had a question about value stocks versus managed futures in your overlay tracking error.
You're gonna love this because it goes back to my
Yeah.
long short portfolios all the way down.
Exactly.
Okay.
I thought you loved teeing you up.
Well, oh god, this might force us to talk about return stacking, which we avoided all of season 2. Okay, so
We'll definitely get to that.
Here's the setup. Here's the setup for the question, Jason. You have a 60-40 portfolio, 60% stocks, 40% bonds. And I give you a choice. I say, I'm going to take all the stocks and replace them with value stocks, right? So I'm buying companies that are cheap, price to book or price to earnings or whatever, some sort of systematic value strategy. Or portfolio number 2, I am going to 60-40, and I am going to add on a 60% notional overlay to the SocGen CTA index. So manage futures. Which of those portfolios do you think has higher tracking error to the original benchmark? The original 60-40.
Okay, clarify. You're talking about original 60-40. Then
Yep.
you have 60-40, we're replacing 60% with value. Right?
Yep, so the 60% stocks are now value stocks.
Value stocks. And then you have a 60-40 with an additional 60% overlay to manage futures.
Yes.
And then you're asking which one has more tracking error to 60-40.
Yeah, so which one has more tracking error? In other words, like if you take its return minus your vanilla 60-40, take the standard deviation of those returns over time, which one has a higher tracking error? Which one has more active risk is another way of sort of putting it.
So I want to go with I have so many things running in my head right now, and I'll tell you why after. But I'll go with the value had more tracking error.
Yeah, I think it had slightly more tracking error when I actually. Oh, now that said, you can't invest in the SocGen CTA index, and it's sort of like weirdly artificial.
Right.
It's like a managed futures mutual fund. They come out about equal, right? And the point of this.
But do you think that the Momo is from just like a stock index that has Momo embedded in it versus value, and then you get a bit of Momo with trend following?
No, I'm not sure that's really it, because like the Momo is within equities, whereas trend following is time series. The Momo you're talking about is more cross-sectional. But I think what it comes down to, like, there is this aversion that people have to leverage, right? Like the idea of taking a 60-40 and layering on top a whole separate return stream sounds very scary. So let me rephrase the first one where we replaced equities with value stocks. You own your 60-40 and then you add on exposure, 60% notional exposure to long value stocks.
Yeah.
Now which one has more risk? You know, like, okay, now they kind of sound the same, right? They kind of sound the same, right? And I think there's this acceptance of like, okay, I can replace all my stocks with value stocks. That's like, for some reason, post 2000, people accept that. But the idea of trying to layer on top a diversifying alternative is very scary. Now, I should caveat that there are knockout conditions that come with using leverage. So there are different risks here that, like the first one, you're not explicitly layering on a long short. It's very implicit, and you can't get knocked out from a leverage perspective. If I layer something on top with too much leverage, I can get knocked out of that position. So there are sort of default risks here. We have to
path versus terminus, right? Path versus
terminus, absolutely, coming full circle.
If your margins get cranked up with volatility, yeah, you could have a.
But once again, like, I guess my point is, like, you know, I people should just, I guess, follow me on Twitter if they want to know what we're going to talk about. It's just all my tweets from the last, like, your tweets, my tweets. Like my point was, like, you know, you tell someone to replace their stocks with value stocks and no one bats an eye. You tell them to add a 15% overlay to managed futures and everyone loses their goddamn mind.
Well, I mean, I love the stories from Eric Crittenden, like just like removing the names and everything and just showing the kind of return to risk profiles and what people would actually select. But then nobody actually does it in real life, because it's like full circle to all the things we're talking about. It's like, you know, what's the optimal strategy versus the robust strategy, and then what are people going to do when they're making decisions on opacity? What I was saying was running through my mind when you were setting up the index versus tracking error. What was actually running through my mind is shout out to My First Million podcast and show. I always send you clips from there. But what was running through my mind is Sean on there is always talking about, you know, as a homie, you need to really set your buddy up. So if he's like, you know, if something makes like $100 million and you're like, guess how much they made? I got to go like 10 million. So you can go, they made $100 million, you know? So I was like trying to think of like, I was trying to run the game theory
You're
on how to
trying
make you look
set
good.
the homie up.
Yeah, exactly.
Listen,
And
man,
it didn't.
you can give me a layup, and I will fumble the ball to use like
Mixed metaphors.
yeah,
Even.
mixed metaphors on purpose to explicitly fumble my own metaphor.
Exactly. You know, I need the hive mind of our 9 listeners. And so I know I put this in the in our notes, and you're probably like, what the hell is Jason talking about? I said wild baby fox problems for Jason.
Yeah, you have to expand on that one, please.
So, for those who don't know, I live in Northern California in wine country, and it's very rural here. People have no idea. Like, I think when people come to like Napa Valley or other wine regions, you know, it's a Disneyland for adults, right? But when they come, you know, they dress up, they get a chauffeur, they go to these wineries, they spend tens of millions of dollars to make it look, you know, unbelievable. So you think it's really sophisticated and urban, but it's incredibly rural. Like, we're just basically a farming community. I think like the whole county has maybe 150,000 people, so there is a lot of wildlife. So even if you live in, you know, like a town like I do, you still are dealing with a lot of wildlife. We have a lot of coyotes, bears, etc., and yet that's what you have to deal with. But we've got to run into a new problem, and that a few months ago, I guess my neighbors, they had a fox that had burrowed under their garage, and she had babies. She had two baby, I think it's 2 baby boy foxes, and so they've been kind of running around the neighborhood. Well, lately they've seemed to really enjoy my yard. And not only so they really come out at night, and these two love to play on my roof at about 12 at midnight to about 2 a.m. They're running back and forth across.
How do they get on your
Yeah.
roof?
There's like you know, trellis systems, and then there's a fence line behind us, and I think they actually use my roof to look at the chickens behind us that are all like pent up at night. So that's their vantage point. So you hear them like trying to break in the chicken coop. You hear them run around the roof, and then what happened was last night at like 4 o'clock in the morning. I don't even know how to express this other than one of them must have had like a dry cough. So he's out hacking away right outside like my bedroom window, waking me up at 4 in the morning with his dry cough. So why I bring this up is I'd like the hive mind of our 9 listeners is if anybody has any ideas, please put them in the comments. But like, it seems like historically the best ways people are like motion detected lights, sprinkler systems, and dogs tend to keep them out of your yard, which we don't have any of the 3. So the only thing I'm trying to use is human pee, and hopefully that will like get him off the scent. So you can get where I'm going.
Wait. We're not. Well done. We're not jumping over that. Did you just say you are using human pee
Yeah.
to try to get rid of the foxes?
Yeah, that's my only long shot at this point.
I've got nothing else to say. We're done. We're done. We're done. That's it for the day. You know what? That's the high note. So, ladies and gentlemen, we're experimenting with human pee to get rid of foxes. This is what the quality content you get on the Pirates of Finance.
Well, I guess we'll go find out if my pee has any alpha domination over the animal kingdom.
Okay, no.
Maybe we need to run a cohort experiment with like diet centric.
All right, no, but seriously, ladies and gentlemen, this has been the Pirates of Finance. That man who's
obviously not investment advice.
Yeah, clearly not investment advice. And the man experimenting with his own pee is Jason Buck. You can find him on Twitter at Jason Mutiny. I'm Corey Hofstein. You can find me on Twitter at C Hofstein. Huge shout out to Tyler behind the scenes, making this all work for us. Thank you for doing everything you do. Thank everyone
He's
for
at Tyler Rungione.
Oh, yes, thank you. At Tyler Rungione. For tuning in, whether live or later, please give us a like, subscribe, comment. We love to hear from you. And with that, we're out.
Thanks, buddy.